Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major Real Estate Podcast. My name is Nathan Sosa, and I'm joined by my co-host, Matt Hamilton. And Matt, man, I'm going to tell you, it has been a nonstop show of webinars, conversations about, you guessed it, the one big beautiful bill. And what topic do you think everyone's been asking? And I'm asking you about specifically too.
I can only assume that if you're on a webinar full of real estate professionals and people investing in real estate, the number one topic that keeps coming up over and over again is 100% bonus depreciation. How does this help me? How does it apply? Can I benefit from it? What's going on there? I can only assume that's the top of mind for a lot of people.
It really has been. No one else has cared really that much of the other provisions. I don't get very many questions on no tax on tips or no tax on overtime as much as I thought I would. But man, it's been nonstop. And I totally get it, right? It's a very important provision for real estate investors and trying to understand how to utilize it. Because especially we get this really weird January 19th cutoff that we talked about in the last episode. That's basically like, hey, guess what? And not to get political, but after a certain person got inaugurated, then a lot of benefits happened to flow. A little bit of political messaging there. We won't go into that, but it's just like something Matt and I were talking about beforehand is that it's so interesting with policy, like how tax policy, in my opinion, should not be political. If you decide that it is, that's fine. I can see the arguments for it, but in my mind, it's more of an economic thing than a political thing. But then again, I guess politics and economics kind of go together too, don't they, Matt?
Yeah, they do. And the unfortunate or fortunate reality, I suppose, depending on who you are and what your beliefs may be. But, tax law and any other law is written by politicians, and politicians have political motives for everything they do. So I think it's important to understand those motivations when you're kind of interpreting the law to try to understand what the purpose of these laws are and who they benefit and why they benefit them. Because I think that really allows you to take advantage of a lot of these provisions in the tax code as much as possible. But it's important to understand that those motivations always exist.
Yeah, absolutely. It's good to understand the intent behind things because then that helps us figure out how we can use these items. Tax is chess, right? Tax is chess. And it's like if we understand why the rule was made in chess, that helps you understand how you can use the rule in chess. Not really a big chess player myself, but I just like the analogy. So the other thing too, man, I've been seeing constantly is the use of AI to create content around this bill that is basically unfettered. I was literally just talking with someone and they're like, oh, hey, what about this rule? Someone made this OBBB GP, this OBBB, I apologize, OBBB GPT.
I forgive you.
And this is what it's telling me. And someone who has been very much using AI as a tool, but also read the entire 400 pages of the finance bill that was related, not just the pieces related to tax, but a good chunk of it is reading it and goes, what is this even talking about? And now it sends my brain spiraling because I'm wondering if I'm missing a piece or something like that. And it's just crazy that you see so much information that's disseminated, that's created by AI, but it's inaccurate, not understood by the person who's reading it from AI. It's just really crazy to honestly see all that stuff, in my opinion.
Yeah. Can I share a hot take with you, Nathan?
You should definitely share it. As many hot takes as you want on this podcast.
So I heard a statistic recently where apparently the vast majority of all of the content on the internet was produced in the last year. And that that number, that percentage keeps increasing by the year. And because there's just so much content being created by so many people, and that number of content creators just increases by the year, and there's just so much content. But now with AI, that's exploded even more. So now there's just tons of AI just pumping out content. And I am convinced that we're very closely nearing a future where most of the internet is just going to be AI learning from and talking to other AI. And we're kind of getting to a point where what you just described is becoming more and more common, where there's people, I'll say, proliferating content that is not necessarily fact-checked or fully understood by the person proliferating that content. So it's really important. It's becoming increasingly important. And not just even in the tax space, but it's becoming increasingly important to work with professionals that truly understand what they're talking about. And the delineation between professionals that do know what they're talking about and don't know what they're talking about it's becoming more and more difficult to kind of decipher between the two. So all that being said, be careful out there. AI is becoming increasingly.
I think it's actually good to have a conversation about AI even on this podcast because look, syndicators are using it. I've spoken with several. I'm sure you've spoken with several that use it. Right? There's some people that are very big on Gemini. Some are very, very big on ChatGPT. Not as many use Claude. I personally love it. I use both it in chat and Gemini. I have too many AI tools at this point, probably. But I think it's important to know. And it's a report made by, I think Harvard. I want to say it's Harvard, talking about, they did a poll people who had AI generated papers versus people who actually used AI to help them create their paper. Big difference, right? Big difference to having AI write it, right? And so people who used it to help them write the paper had a much better retention of it and had better cognitive recall of the information versus people who didn't. Now, unfortunately, the headline basically of the article basically says AI reduces cognitive function, right? It's that was the headline of the article. It's not what's actually happening. It was just the recall was better. But to me, that's important because AI is going to continually help us do things that are really things that we feel are simple or quick that it can do, right? It can read and research a PDF much faster than we can read and research it. However, we still have to go read and test our brain by reading that PDF. It's something this person is definitely a content creator. They said essentially, so look, a lot in America now, we don't have to do as much manual labor as we once had to. That's not saying that it doesn't exist and we shouldn't do it. But guess what? When that happened, people began more consistently to exercise, go to the gym, do those types of items, right? Because of that, because we wanted to continue to train our bodies because we no longer did manual labor. So what's next, right? What's next when AI does a lot of our brain work for us is that how do we test that? And it's going to be doing difficult technical problems in our head, right? Business owners are going to continue to be way leagues ahead of everybody else, indicators, because they're still doing all these mental gymnastics in their brains, reading books, doing those types of things. That's how we're going to continue to further our minds going forward, right? And not just let AI do everything for us and lose that creativity that exists in the human mind, in my opinion.
Yeah, no, I think that's actually a really interesting analogy. I never really thought about it like that. But I mean, to be clear, I'm not anti-AI. Just like you, I use AI on a daily basis.
Yeah, absolutely. No anti-AI people here. We are big fans of LLMs. Artificial intelligence is different of LLMs and how they can be used.
Yeah, it's just important to exercise caution.
Absolutely. Yeah. So now that we're done ranting about AI, now we can actually maybe talk about tax, Matt, and go back to what we were talking about for bonus depreciation. And Matt, it sounds like you also be getting a large influx of questions from clients on how they can use bonus. Are they cut out from it? Right. This is what sucks, in my opinion, is that we've only really had these weird cutoffs twice, both under a certain administration. Back in 2017, we had a weird September 27th, 2017 cutoff, right? So you had 3 months of the year where you could be eligible for 100% bonus depreciation. It's really interesting. There were some things behind that kind of made sense. This time, we have any property purchased before January 19th is not eligible for 100% bonus depreciation. But anything that is acquired and placed in service, it's really key, and we'll talk about why, after January 19th, so 20th forward, is eligible for 100% bonus depreciation. So we have these, I call the unluckiest 2 weeks of the year, in my opinion. There's another group that's pretty unlucky too, for the qualified small business folks. I don't think they're as affected as people here, but I think the bonus depreciation people, because we didn't get this news until February that this was going to be the case, right? So that was there's literally nothing you could have done to prepare for this. It's just Congress being Congress and a president being a president.
It truly is unfortunate because a lot of times with these tax changes, and with the one big beautiful bill, it was in Congress for, there were pieces of it floating around for months to where we kind of knew what to expect and we had an idea of what changes might be coming. And you can begin to kind of plan the back half of 2025 for what changes you might think are coming down the pipeline. But yeah, no, to your point, I mean, for this change specifically, we didn't even know it was a thing until a month after this date closed. There's no planning for it. It's just kind of a crapshoot for whether or not, you happen to land on a lucky date or an unlucky date if you happen to, acquire any new properties early in the year.
Yeah. So what's also sucks is that we're going to do all this planning around this date just for this year. It's not what's not great is that we don't get to take this strategy or take these strategies and discussions into the following year because the same thing applies. No, it's literally this year. So it's a headache that only applies for this year. And honestly, like I'd rather have headaches that I get to, I don't know. I was about to say, like, I want to have continuous headaches, but I don't know if I want continuous headaches. So maybe it's okay that we just have one maybe it's okay we just have one-time headaches. And the fact, so I guess that's a good and a bad thing, right? The good thing is we don't have to worry about it ever again. The bad thing is we have to worry about it this year.
Yeah.
And so, Matt, what are some of the specific questions or issues that you've had syndicators come to you on so far when it comes to bonus depreciation? Like, what are some specific items or questions they've asked you so far about how they can use this and how it ultimately applies?
Yeah, so there's two primary buckets, let's say, of people who are affected by this. There are people who employ acquisition strategies in their funds and syndications where the fund itself is acquiring property. And there are folks that are deploying a development strategy where they're buying land or whatever else to develop property on it. And those are two distinct different buckets that are impacted by this cutoff in two distinct different ways. But focusing on the acquisition piece, because I think generally speaking, it's more common for syndicators to apply an acquisition strategy. It's more cut and dry for acquisitions early in the year, which is great because it makes it simpler for the majority of people. And some of the questions I've been getting is oftentimes like, hey, I closed on a property early this year. What are my options here? Am I just like out of luck? What's going on? And oftentimes we'll kind of get into what this looks like here in a second, but it's really just a lot of questions about the simple application of like, these are the facts. This is when I got the property under contract. This is when I acquired it. This is when I placed in service. Am I out of luck or do I get 100% bonus depreciation? Like we just said, unfortunately, there isn't really much planning or things you can do to kind of change it up or move things around. It is what it is. You can't really change the facts that happened earlier in the year. So it's really just a quick application of like, this is my fact pattern. How does this apply to me?
Yeah, absolutely. It's hard questions to answer because at the moment, we don't know the exact rules around it. We don't know because Treasury hasn't released the exact regulations upon it, right? So what happens a lot of times, Congress passes the bill and then they're like, hey, here's the text. And that becomes a code. And they go, okay, great. But it doesn't necessarily explain everything that is supposed to happen behind the scenes because a lot of situations where the code, it's like, hey, you can read into it or make decisions. So what will happen is Treasury / the IRS will release proposed regulations upon what's going to happen. Just FYI, with Tax Cuts and Jobs Act, we got the finalized version in 2020, 3 years after this bill got passed. So we might have a little bit of time where we'll have to be working on the proposed regs. However, they always had like a carve out. So when they got to finalize regs, they said, hey, if you worked out the proposed regs and they're issued, fine, you can use those, right? And anyone who works now, who's doing things now, you got to use the finalized regs going forward.
Yeah. And you mentioned a couple minutes ago that this isn't the first time we've seen a cutoff like this. In recent history with tax legislation like this, and the Department of the Treasury has released regulations on how they handled a cutoff like this in the past. In your opinion, what are the odds that the regs that come out, the proposed regs that come out, we assume will come out related to this new legislation? What are the odds that it takes a consistent approach?
I would assume it's pretty high and likely. I'd be shocked if they made any crazy changes. There probably isn't a need to do that. So I would just use these inferences. I would personally use it until we get further guidance. It's the only thing we have to go off of. So until we get more guidance, right? So we're going to play under assumed rules for tax planning purposes. Thankfully, we'll probably get some proposed regs at least by November. I would love for it to be earlier. It ain't going to happen at the state the IRS currently is. Lots of higher up level people are consistently leaving. And those are the people who create the regulations. So that creates a problem when the people who normally create the regs and you go, hey, you need to write this. And they go, yeah, I'm going to go. And so that creates issues.
But I think that also lends credence to the fact that they're probably going to maintain consistent treatment because it's the least amount of work.
That's an excellent point. I hadn't thought about that. I hadn't thought about the human I don't know if I'll call it laziness, but it kind of is the human laziness just goes, yeah, I'm just going to copy your homework and go and move forward, right? I'm going to see old copy your homework meme, right? And copy your homework and move along.
I mean, if all that experience and human capital is leaving, the natural thing to do would be to take the path of least resistance. And if the fact pattern is so similar, then maybe there's really no need to rock the boat.
That's a great point. I think you're right on that. So it's a good assumption that we'll continue to use. And so why does it ultimately matter? Well, unfortunately, there are people who purchase property, let's say January 4th, and get it placed in service January 31st, right? Or something of that nature, February, whatever the timeline winds up being. Acquisition, closing happens early January, place in service after January 20th. What happens to you? Unfortunately, you're going to be stuck at 40% bonus in this example, which probably isn't great news to some of your clients, Matt. Real estate syndication tax is confusing to you. Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you'll be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed.
No, not great news. And the unfortunate reality is there isn't really much you can do about it. I've had some questions asking, can I sell this property to another one of my entities to kind of reset that place in service and acquisition date? And the unfortunate answer is no. If there's consistent control between the LLCs and the related parties, it's not really going to work. I suppose if you wanted to sell it to an outside party and buy it back, I guess you're able to do that, but I wouldn't let the tax dog wag the tail because you're probably going to lose a bunch of money by doing that. So,
it just becomes more trouble than what it's ultimately worth at the end of the day to try and go through all these hoops. And look, and I'll say this too, is that for the syndicators working with commercial, strip malls, anything that's commercial property, you can still use 179 expensing for a lot of your assets. That didn't get affected with January 19th cutoff, just bonus depreciation. So just an FYI there. So those changes are still eligible for you to use and utilize. So just remember that, is that while bonus depreciation technically is no longer available for us, that doesn't mean that we can't use 179 expensing. Obviously, there's a lot more rules and things we have to think about with 179, but just an FYI on that piece. Is that and Matt, do you think that's going to help out any of your clients being able to still utilize a higher 179 limitation?
It'll certainly help. Obviously, 100% bonus is preferable to 179 if at all possible. But if people find themselves in this scenario where they are impacted by the cutoff, 179 deductions are better than 40% bonus depreciation. So if you're kind of weighing your options, it makes sense to explore both those options if you find yourself in that specific cutoff limitation scenario.
Yeah, and so there are some specific rules around that bonus depreciation. So quick aside, 179 we can definitely use and utilize. But going back to bonus, right? 179's the older cousin of bonus, but bonus is what we mostly talk about and use nowadays because 100%. It's great. It's easy, unless it's 2025. And so some people have asked me, okay, I have a contract to buy a property or a purchase sale agreement or an LOI to purchase property, assets, whatever it winds up being, whatever we're syndicating. And so basically they go, I purchased it or got the contract in 2024, got the asset after January 20th. And the question I've gotten a couple times is what happens now? And I have to ask some clarifying questions. And so basically, if you have what's considered to be a binding contract, there's a regulation that specifically defines what a binding contract is. And essentially, if you have this contract and you enter into it, whether down payment or whatever, and you go, I'm going to walk away from this. The question is then, what happens when you walk away? Do you get sued for damages? How enforceable is it from a state law perspective? Look, all the time people in real estate, right? You go into making offers, buying things, et cetera. People walk away on a frequent basis unless it's larger assets, right? That's where it becomes a little bit different. When it's a larger asset or a construction type property, those are a little bit more binding. Or would you agree, Matt, that those you're going to have issues if you try walking away from a large construction project or a purchase of a large multifamily property?
Yeah, absolutely. It certainly increases the probability of that being the situation you're finding yourself in. It's not the same as acquiring a single family home or anything like that. So it's important to understand, and I assume you're probably working pretty closely with your attorney whenever you're drafting up the contract to acquire a property. You understand what you're getting yourself into, but if you're not 100% sure if what the implications are of walking away from that contract, definitely talk to your contract attorney who helped you put that together, just to get that extra information to understand if what you've entered yourself into is or is not a binding contract for the purposes of understanding whether or not this applies before the cutoff for bonus depreciation.
Yeah, it's going to be really important to have legal advice on this, right? Matt and I are accountants. We're CPAs. We are not attorneys. So I can tell you what maybe a non-binding contract is or what a binding contract is. I really don't know at the end of the day. I'm like, I could read it, sure, but that's legal advice, and I don't like to get into that territory.
Hashtag not legal advice. Yeah.
So Matt basically said he's fine with giving everybody legal advice, I think, right?
Mm-hmm. Yeah. Oh, well, for legal reasons, I have to deny that claim and say that I am not capable of providing legal advice. So, Brandon Hall, if you're listening, I am not offering legal advice.
Not through Hall CPA, at least.
Not through Hall CPA. No, but if you want to give me a text, hit me up.
Yeah, if you guys want to work with us, if you want to work with Matt specifically on legal advice, I'm not sure how you reach out to him. But if you want to work with us at Hall CPA, check the links below. Look, like I said, these are weird situations to work through, and you guys should make sure you have someone who knows this stuff and is on top of it, right? We're already breaking this down and trying to figure out how it applies to you, right? So you want to work with someone who's proactive and who knows their stuff like the back of their hand. And look, we are making guesses, but we're trying to figure out and give you guys clarity on this. So check the link, the show notes, links in there. Come work with us. We'd love to have you. So back to when this gets weird and funky, right? So that binding contract, I had someone ask me, it's like, okay, someone buys a jet plane and they down payment 2024 and then gets delivered in 2025. What happens? That's not going to be 100% bonus eligible property, unfortunately. And it's going to be the same thing with real estate as well, right? You go to closing documents, PSA, et cetera, everything gets signed in 2024. You get a place that starts end of January 2025. This is where the specific and test is really important of the bill. It's acquired and placed in service. So that means you're just trapped with 40%. I know we've said it a couple of times. I just want to reiterate that. Now, you might have some flexibility if it's a non-binding contract. So just FYI there that there could be flexibility potentially. I'm not going to guarantee that, but that could mean the acquired date could be a different date potentially, depending on when other things were signed, et cetera, when actually things were considered to be quote unquote acquired. Do you see any flexibility or anything that you can do there, Matt? I mean, I know that's maybe it's more legal type stuff, but any flexibility you can see helping out there?
Yeah, I mean, like you said, that really ventures into the territory of legal advice. But I encourage clients to reach out to their attorneys to understand this and then loop in the CPA so we can kind of have your CPA and your attorney talk to each other to try to understand what exactly are the legal implications of these contracts? When are they placed in service? Because at this point, what we're really trying to emphasize is this is the type of information and types of questions you need to be asking your team, whether that's your attorney, your CPA, ideally both, in order to maximize your deductions on your 2025 tax return. So if you're listening to this and you're concerned that you might be in a situation where your bonus depreciation for 2025 is limiting, what you need to be doing right now is just taking notes on what information do I need to be putting together right now to send to my CPA and my attorney to put myself in the best position possible for next tax season.
Yeah, that's a great point, Matt. I think it's good sound advice to do that. It's you want to get your whole team involved, right? I saw someone post today the 8 things that you need to have it as a successful entrepreneur or syndicator. And someone boiled it down. Hey, you should really need 3 or 4 things. You need good accountant, good business coach, a good attorney, and a healthy lifestyle. Those are the 4 things. If you have all those, you're going to be locked in, good to go. So just make sure you have that team behind you. And okay, Matt, so we talked about the first bucket, the acquisition people. And there's not a whole lot of flexibility we can utilize there for them, unfortunately. What about your developers, your construction folk? What questions are they sending your way? What are they looking for or trying to get help on?
So it's a little bit more complicated there because construction projects are not cut and dry. They drag on for, I would imagine, a lot longer than most developers would like them to in most cases. There's a lot of moving parts. So the questions I'm getting from developers is really just what does this mean? Can I just place the property in service whenever it's done? Let's say this property isn't even placed in service until the end of 2025, but it's been in development for 1-2 years, however long it's been. What does this mean? How does this apply to my scenario? So a lot of it is just what I'm seeing is confusion around how this applies to development because it's not super clear. It's kind of confusing.
It definitely is very confusing, in my opinion. It's very confusing. I mean, Matt and I were just talking this before the call. We're all right, we feel we got this down. And we talked through and maybe we don't have this down. Maybe we shouldn't record. And we're okay, then we got back to okay, wait. We feel good about this. We're good to go. And I still feel good about this. But there's a lot of ambiguity to what happens at self-construction. So basically, I'll walk us through what's important. What's important is how close you were to 10% of construction and when you got close to that date. If you were under 10% of construction and you're a builder, then your acquired date of the property doesn't happen until you are greater than 10% of completion. So if you started in 2023, for example, you're viewed as acquired in 2023, placed in service in 2025, assuming you finish this year. Unfortunately, that means you're not eligible for 40% bonus depreciation. But on the flip side, if you were less than 10% in 2024, and then you cross that 10% threshold after January 20th, then you could be eligible for 100% bonus depreciation in that example. So there is a possible workaround. However, it's like figuring out what qualifies as construction costs. It's not going to be like preliminary activities, prepping land, surveying, securing financing, exploring, researching, all that jazz. It's basically 10% of the total cost of the property that you're expecting to outlay, right? So that's going to be what's important here. You don't include the cost of the land either, just FYI in that. You just look at the cost of the property built. What do you think that does for our syndication clients, Matt?
It's hard to say, right? Because it kind of depends. It's very, not only is it client specific, it's very project specific. These development projects move at different rates. There are some projects that break ground in Q4 24, and they've already passed 10% of the total projected expenses. And there are some projects that probably started in late 23, early 24 that still haven't hit 10% for whatever reason with delays. So it's really all over the board how this applies to people. But the biggest takeaway, if you are in a situation where you're developing a property and you're in charge of the construction, the development that's going on, what you can do right now to give yourself the best footing for tax year 2025 is to just start gathering data, gathering information, and taking notes on your budgets, on what expenses were outlaid over time. Whenever you broke ground to where you are right now, what expenses have you incurred on each project? And what is the total expected budget? And just kind of starting to gather that information, because that's the information that your CPA is going to be asking for in January, February 2025. And you don't want that to delay your tax returns because you have to go back and gather that information in the future. It's only going to become more and more difficult to gather that information the further and further you get into the future, right? So it's important to start thinking about that now and gathering that information.
So what I'm hearing, Matt, is having good accounting books and records is really, really important. And you should work with good accountants to do that. Is that right?
That is 100% the case. That wasn't my intention, but I feel like a lot of what I say, the central thesis is it's really important to have accurate and diligent record keeping. As lame as that sounds, that is the bedrock of what allows you to take advantage of so many different tax loopholes, tax advantages, tax incentives. All of that can't happen if you don't have accurate financials, accurate bookkeeping, and accurate records.
Definitely. And once again, in the show notes, click. And guess what? We have an amazing accounting team that can help you out with doing that kind of stuff. So just don't ignore it, because it's going to be really important in 2025 and in 2024 or whatever is happening. And so one last thing I'll mention. So far you're like, I'm screwed. I can't get 100% bonus depreciation. I'm just out, right? And so you probably should have said this before. I hope you didn't click off yet, because there's one more thing that we can potentially do to help you out here. So if you fall out of this unfortunate date and you're looking at 40% because you acquired before, placed in service after, you're kind of in a bad situation where you're not going to be able to ultimately utilize bonus depreciation. There is an election called a component election where you get to what I call componentize, not a real word, but I'm going to do whatever you do to make it yours, where you can componentize certain systems as they're placed in service throughout the year. This is only going to work for large construction builds. Anyone who's doing smaller residential, probably not going to happen. But larger construction, absolutely, you can probably look into this. And the cost seg and the record keeping is going to be insanely important, because if it's going to be HVAC unit, security system, those types of things, as they're created and placed in service, you can then make this election and apply it across the board. And that'll allow, while you might have a good chunk of the property that's only eligible for 40%, there's still some items that you could potentially have be 100% bonus depreciation eligible by using this election.
Yeah, so in other words, it's basically taking a larger development and breaking it down into a bunch of smaller developments because it makes it easier to pass this 10% test. If you're dealing with a ton of small developments because there may be smaller components that you're still working on in 2025. But again, this only becomes possible if you have accurate records and you start gathering that information now. That just becomes critical, especially if you're in this scenario where you're breaking it down by component. Because if you're having a conversation with your CPA, 6 months down the road, and they're asking, all right, well, if we want to make this election to split your development into components, when would you say that 10% of the HVAC units were completed? Well, that's going to be a really difficult question to answer if you don't have all those records and notes in front of you. So, like I said, it's just really important to start gathering that information now.
Yeah, Matt, 100%. So once again, good accounting books and records, good tax people who know what they're doing, and good attorneys, right? We'll give the attorneys a shout out here. So having all of that together on your team is super important. So once again, if you want to work with Matt and I, click the link in the show notes, follow us on social media, LinkedIn, X, or Twitter, whatever we're calling it days, sometimes both, sometimes neither.
The app formerly known as Twitter is
formerly known as Twitter. So give us a shout out, follow there. I'm going to keep doing content about this bill. We'll continue to do webinars about it. So just keep a notice on our page, get on our email list, and you guys will get those updates. And then Matt, thanks so much for jumping on today. And this has been another episode of the Major Real Estate Podcast.